Hi, everyone. This is Jeff Praissman with the Interactive Brokers Podcast. It's my pleasure to welcome back to the IBKR Podcast Studio, Dmitry Pargamanik from Market Chameleon. Hey, Dmitry, how are you?
Hey, Jeff, thanks for having me.
I always love having you swing by the studio after you do your webinars. And for our listeners, Dmitry and Will from Market Chameleon do a morning show on YouTube every day. What is it, at 9 a.m., Dmitry, that it starts?
Yeah, we usually do right at 9 a.m. before the market opens.
They're also frequent contributors to the IBKR campus through articles, through webinars, and our monthly podcast as well. So, Dmitry, today we're going to kind of follow up on the webinar you just did on calendar spreads. I want to kind of kick it off with a question of, why do calendar spreads offer a unique way for traders to, express their market view beyond simply just being bullish or bearish?
Yeah. And, calendar spread, it's an interesting strategy. It's actually, we looked it up because one of the customers just asked us, well, it's how popular are calendar spreads? And when you look at strategies, multi-leg strategies right now, it's the second most popular after vertical spreads, although vertical spreads are much more, maybe like 10 times more popular than calendar spreads. And vertical spreads usually let you express a bullish or bearish view. In a calendar spread, you're looking at two different expirations where you're buying an option in one expiration, selling an option in a different expiration in the same strike. And that has a different type of risk profile and outlook because now you're looking at a term structure where there are implied volatility of two different expirations. They could be different. And you're going to, by trading that strategy, you're trying to take or capitalize on that difference in the premiums between two different expirations.
And, Dmitry, we always seem to talk about implied volatility when you guys are on, and this is no different, right? So implied volatility is really actually a key component. I mean, it's a key component of options in general, but like definitely a key component of counter spread trading. So
Yeah.
how should investors think about volatility when they're evaluating these strategies?
Yeah. So when we look at calendar spread, there are a couple things about calendar spreads when we look at the Vega risk of an option. The Vega risk of a option that's longer term, longer dated is much higher than a shorter term because that option has more premium and it's more sensitive to one implied volatility move. Okay, so it's not exactly the same if you have two options, one that expires in 10 days and let's say one expires in 100 days. Well, the Vega risk with that 100 days is much higher. So one volatility click, you know, in an option with 100 days to go might, let's just say it increases or decreases by 20 cents, while the corresponding 10-day option, it could be a penny. So there's an implied volatility difference, but there's also a Vega risk associated with each option that, each trader has to understand because one volatility click move in a 100-day option can correspond to 10 vol clicks in the shorter date. So it's not, one for one when when each of them moves. So that's an important piece to understand. Well, what does one vol click correspond, you know, to from a longer dated correspond to a shorter dated? Because, when you're looking, for example, some kind of a reversion, if one vol click goes down and the other by one and the other one goes down by five, that might not be enough, to offset. So you have an implied volatility difference, but you also have a Vega component that you need to factor in.
Yeah, that's a good point with the different expirations because so many standard, spreads like verticals and straddles and strangles are all the same
Yeah.
expiration. And
Yeah.
that kind of, leads me perfectly to my next question because, so many traders, they focus just on, stock price direction, but really
It-
time is such an important factor when it comes to calendar spreads.
it-
Kind of dig a little bit more into that.
yeah. So with the calendar spreads, you have two different components, and you have two different expirations. And those expirations could cover different things as well. So a certain expiration can cover, let's say, earnings, and another one doesn't cover earnings, or covers an event, or it can cover a different type of event while the other one doesn't. So the timing really matters when you put these spreads on, unlike a vertical spread, which covers the exact same time frame. They expire all at the same time. In a vertical spread, calendar spread, well, you have the strategy, but the strategy really ceases to exist after that first expiration, right? So after the first expiration, what will happen is, well, your shorter dated option, if it's worthless, it goes away. Now you have just that longer dated option. If it's in the money, well, that will get assigned unless you close out of it. So if you get assigned, well, then you're left with a position where you have a stop position and an option position. So the time there really matters with options, how you put on that spread and all the different factors that play into the time component.
And how can investors determine whether a counter spread, appears relatively expensive or cheap before entering the trade? Because they're really dealing, again, back to those two expirations, it's a little hard to kind
Yeah.
of do apples to apples.
Yeah. That's the issue with time spreads is, okay, now we have these two different expirations. They have different implied volatilities, different in relationships
Mhm.
relative to each other. So how do we know, if it's the combination of that spread on the low end or high end, right? So implied volatility alone doesn't tell us, an implied volatility benchmark alone won't tell us, because we need to know the relationship of buying one versus the other. So there you have to create a different benchmark where you measure historically that actual combination, that strategy. And then you could get, just like you would imply volatility, but you could get a low end, high end, average, median value for that strategy, and then compare that to the market prices. So it involves creating a new type of benchmark that's more specific to, where the strikes are relative to the spot price and how much time is left to expiration in each of those components. Using those conditions, then you'd have to go in history, find those conditions and see historically where that spread, was
Mhm.
valued.
Yeah, and how does that, that relationship between, short-term and longer-term, option pricing, how does it play in the success of a counter spread?
Yeah. So, when we look at there are a few things in a calendar spread where you have these outlook. So I'll go over like a long calendar spread, because the short calendar spread would just be the opposite of that
Mhm.
outlook. So long calendar spread, let's say you have two calls on the same strike, and you're buying a longer term option, selling a shorter term option. Well, one piece of it is you do have some direction bias, because the sweet spot for that spread is that the stop floats and right to the strike price at expiration, the first expiration, right? So if you picked higher strikes, you want the strike stock to go up to that strike. If you pick lower strikes, you want the stock to go lower to hit that strike. The reason behind it is, well, if you're short the shorter dated option and the stock expires right at the money, let's just say, where you don't get assigned or exercised.
Mhm.
Well, that premium that you sold it for, you keep, right? It goes worthless. So you sold an option that's worthless. And it goes away. So that's a great scenario for you. And at the same time, the option that you're long, well, that's exactly at the money. And when an option's exactly at the money, that's where the time premium is the highest, because it's all time premium, right? It's where, you know, there's no intrinsic value. It's all time premium, and it's right at the spot where it's the most time, right? So that's one outlook and bias. But the other one is that if you're long that option, you want implied volatility to go up in the option you're long. So since you're long the longer dated option, your outlook is you're hoping that the implied volatility on that option increases, over time, or, from the time you bought it. So you have those two types of factors that come into play or outlook when you're executing a calendar spread.
I'd imagine again that there's potentially different risks traders are taking when they're doing a counter spread versus, spreads or combinations in the same expiration. What are
Yeah.
some of the biggest ones that they may underestimate when they're implementing counter spread strategies?
Yeah. I think two main risks come into mind. One is that you always do have an assignment risk on the one you're short. So you should be aware of that. So if the stock crosses and they're both in the
Mhm.
money, well, you could get assigned on one of your shorts and you could end up having stock, in an option. On the flip side, you may want to exercise one of your options for a dividend or interest. So when the options are in early exercise, it goes both ways. You have to always evaluate, am I better off holding on to the option or exercising it? If you're looking at a dividend or carry. But the other factor is what we talked about, and that's your Vega risk. And people underestimate where they look only at the implied volatility between the two, but not the Vega risk of the two. And
Mhm.
that's important. What is the relationship? What is one implied volatility change in the longer term? How many implied volatility changes in the shorter term? Does those two eat? Because you could have like a 10 to 1, 20 to 1 ratio, where one click in the longer term option translates to you need just to, you know, break even a 20 click decline, in the shorter term that you're short. So those two kind of come into mind.
And, just to kind of clarify for our listeners too, like you had mentioned, if both legs are in the money, you may get assigned on one. The difference obviously with being a counter spread is even if you're long one and it's a few expirations out, it may not make sense to exercise it. Whereas if it was like a vertical spread, you might
Yeah.
be assigned if there are two legs that vertical spread in the money in the same expiration. Chances are, if you were assigned one, you probably would be wanting to exercise the other one anyway, or as close to it. Not 100%
Well,
guaranteed, but more likely versus your long one that's 2 months out and it's not really,
it,
it's not really worth exercising. Whereas the one that you get
it-
assigned all of a sudden, and now you're
right. I
short
mean,
stock or short or long.
right.
Um,
You have a different position basically where
right, right.
you started out
So,
with. Yeah.
so Dimitri, what separates a high quality counter spread setup for one that may look appealing on the surface, but it carries some unfavorable risk reward characteristics underneath?
I think probably
Mhm.
no one right answer to that. Sometimes people do calendar spreads for different reasons that fit their portfolio or a certain outlook. You certainly want to be aware of the bid ask spreads in them because they could be wide. And when you're getting an execution, you want to get a good quality execution, or you may end up trading on a wide spread where the entry or exit were so unfavorable that it'd be very difficult to make that a good spread. I think that it really just depends on your outlook and what you're trying to do. I think a lot of calendar spreads that we see trading in the market currently actually turn out to be rolls where it turns out where an existing position is coming closer to expiration and that position is rolled into a longer term, but in a form of a calendar spread. In actuality, it turns out to be just a roll where you had
Right.
a position in one option, you went to a different option, closed out of the option you had. But a calendar spread would be something different where you want to hold both positions
Right, opening in both
against each
positions.
other,
Opening
opening both
opening both
positions.
positions versus closing one and rolling it
And
to another.
yeah, exactly. So
Mhm.
sometimes when we see a calendar spread, it actually turns out to be a roll. But like you said, a calendar spread is when you want to be open in both positions.
And why do counter spreads tend to appeal to traders who believe the market may be overestimating or underestimating future volatility?
Also, good question because the calendar spread it allows you to take a certain outlook where you do believe. Well, I think we're in a low implied volatility regime. We might be here for a little while. I don't. You might not think volatility is going to return tomorrow or in the summer months, or you know non-near-term horizon. So you may want to do a longer term contract, but finance some of that with a shorter term to offset some of the costs. So that would be one reason to do it as a calendar spread, because you think, well, over time, implied volatility will start going up. And in the short term, it might stay lower, and then you do it that way. Or you could go in the opposite direction where you think, well, we're in a very high volatility regime,
Mhm.
and I think it's going to stay here for a little bit, but over the long term, this is not sustainable, or it's going to start reverting back to normal where you want to, or like say the next 20, 30 days volatility. But you think beyond that, it's unnecessary because whatever is happening today is going to eventually get repriced, and we're going to start going back to normal. So you do the opposite side of that where you're selling the longer term for the
Mhm.
Vega, but you're hedging yourself and trying to take advantage of some of the gamble or the shorter term swings. So that's typically where you're looking at the opposite sides of them. Again, that's where you think, well, we're maybe overestimated or underestimated longer term relative to the shorter term.
Final question, Dimitri. You actually kind of brought this up a little bit earlier with events. So, how should the investors think about earning announcements or some other major news events or even minor news events when they're evaluating the counter spread opportunities, right? Because you're crossing different expirations, you're kind of putting on different risks, or you have some.
Yeah, exactly. When it comes to options and event risk, looking at
Mhm.
earnings, you have to look at the Vega, because the implied volatility in the shorter term option that covers the event will be higher than the implied volatility of the longer term, but they're not the same Vega, right?
Mhm.
So you're not looking at the same Vega risk. You're just looking at an implied volatility, which implied volatility is just in option terms is the average volatility day removed, but that doesn't factor in a gap risk, right? So gap risk is something different, where that's where the Black-Scholes doesn't have a component for gap, it just has a component for volatility, which it assumes doesn't gap. It hits every price before it gets to a new price. So when we're looking at earnings, I think then you have to really use a different type of model and thought process than just implied volatility alone. You'd have to look at, your Vega risk components, what you think the stock may move or gap
Mhm.
overnight, and factor that into your strategy. There you have a real potential for a big catalyst repricing that happens really quickly overnight. And when we're doing calendar spreads in that situation, that's a much different calculation and model of the strategy.
Dimitri, this has been great as always. I love when you come by the studio. And for our listeners, again, you can find Dimitri and Will McBride from Market Chameleon every Monday through Friday, I should say, every time the market's open on YouTube, 9 a.m. on their YouTube channel. And of course, on our IBKR.com campus, webinars, podcasts, and articles. Thanks again, Dimitri.
Thanks, Jeff. Thanks for having me.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice. Options involve risk and are not suitable for all investors. For information on the uses and risks of options, you can obtain a copy of the Options Clearing Corporation Risk Disclosure document titled Characteristics and Risks of Standardized Options by going to the following link: ibkr.com/OCC. Multiple leg strategies, including spreads, will incur multiple transaction costs.